Hello future CAs, welcome to day 8 of CA final revision, and our today's topic is modification under financial instruments in case of borrower. So, suppose a person has borrowed a loan of rupees 1 lakh at 10% interest from a bank. So, he will be termed as the borrower and it is the financial liability for the person. So, what he will do? He will repay the principal and interest amount for the 4 years, the term decided. So, for 2 years, he continues to pay the principal and the interest amount. But at the end of second year, he comes to know that he will not be able to pay the debt. So, at the end of second year, the modification appears. So the bank will either change the terms, or it will decrease the interest, or it will change the repayment amount. The accounting before modification is normal accounting, which I have already discussed in the previous shot, which is attached below. After modification, the accounting is as follows. So the step one is we will check whether the modification is substantial or not substantial. So how we will check? So we will take carrying amount of old financial liability minus present value of revised future cash flows plus outflow of transaction cost at old EIR. Then the total amount we will divide again by the carrying amount of old financial liability, and by multiplying it by 100 we will get a percentage. If the percentage is less than 10%, it is not substantial, but if the percentage is more than 10%, it is substantial. So the accounting will depend if the modification is substantial or not substantial. So if the modification is not substantial, the step 2 will be we will adjust the transaction cost from financial liability, means we will deduct the transaction cost. Step 3 will be we will calculate the new EIR either by interpolation method, or it will be given in the question. And step 4 will be we will prepare loan amortization table at new EIR. Now, if the modification is substantial, so what will happen? Second step will be we will de-recognize the old financial liability, means we will remove it from the balance sheet, and we will recognize the new financial liability by calculating the present value of future cash flows at new EIR. Now, step 3 will be what will happen to transaction cost. So, the transaction cost of old financial liability, we will transfer it to the P&L account. And the last step, fourth step will be we will prepare a loan amortization table at the new EIR. So, this is the full accounting treatment. There's one question in the book which you must do to understand the concept. So I am attaching the question in the screen. You can try to solve it, and if there is any problem, you can comment down below. I'll make a separate video on this topic and I'll solve that question for you. Thank you.